The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman.
Hi, folks. Basil Chapman. Nice to be back. 2 days, 17 hours or something of yakety yak. Just talking away, going through all these different chart patterns based on the ChapmanWave methodology. Thanks, folks, for being there. I hope you really got something out of it. I know I did. It's really interesting when I always say when you teach, you learn it again and you learn how to express it in even more cogent terms. Well, you should. It doesn't always work, but at least I try always to do that. More importantly, in the 2-day webinar that I just did on the ChapmanWave methodology, the questions were really good. So that means the integrity and the quality of a question can elicit greater insight into the questioner's thinking than the answer itself. And it just leads to a very simple way of giving the answer, because if the question is well articulated, well thought out, it means that the answer has to be very specific. So that was great. I enjoyed it. Pleased my voice held up all the way through, because I used to get practice doing the 3-day, all-day live seminars. I haven't done that for a while, but I don't know if I will do 3 days again. I think there's just way too much for the voice. Level 1, 2 days, and level 3, level 2 on the second day. Anyway, at this particular point, the patterns that we were discussing are still unfolding, and we've discussed something that's quite important. Let me just do this. I'm going to take 1 second here. On this particular chart, I want to draw something to show you right there. I'm going to change the color a little bit. There we go. Okay, now what I've got here, well, first of all, thank you, Steve, for a great lead into the show and a really good 2 hours. I'm sure the audience were very appreciative of that. And now what I'm doing is, there you go. I'm showing that there's a little bit of a difference. In fact, I'm going to make it even simpler. I'm going to make it right to that point, because in time, not any, a little bit in price, we've got a matching scenario. Now, there's a pattern that I've used very often, but I'm talking about very often over the years, because for some reason, although it's a fabulous technique, it doesn't occur that often when you're looking at many charts. So when you see the pattern, you say, wow, I got to take note of that. And it's the rising wedge formation that I've been making a big deal of for my subscribers in my opening call. Now, what I show this particular chart. No. I usually show this particular chart right here. And in this particular chart, you'll see this pattern. I'll make it a little simpler if you're looking at Tiger TV. And, of course, I forgot to go to my Tiger, TFNN.mobi, so that I could see exactly the charts, so that you were getting the charts the way I see them, and I get them the way you see them. So this is very important. There's a rising wedge formation. Personally, I have a tough time with a rising wedge that goes too long and too far, making the apex, in considering what others consider the rising wedge formation culmination, and they consider it as a very significant point of contact for that apex. Getting that is as the rising wedge gets to a narrower and narrower trendline resistance, trendline support, that it should pull back very sharply. I see it a little differently. I see it as the potential for a conflict between the pattern I call the arch formation, or the dreaded H, the lowercase h, and a powerful move that, if it breaks to the upside of the rising wedge resistance, does exactly the opposite. It has a very strong move to the upside. And we're kind of cusping right now. Leg E in the Dow. But now let me do this. If I go back to the chart over here, where I've got the technicals, that is the MACD and the stochastic and the moving averages, and I show you that move from 12,035 back on June the 4th. Yep, June the 4th. Went to peak A, B, and then C for that rising wedge, and then pulled back to the 200-period exponential moving average, and then went on to D, came back to the moving average, but a higher level, went to E, came back to the moving average. So it goes from 12,035 to 12,898. That's C. ChapmanWave methodology says from the most obvious low, this is the easy way to do it, from the most obvious lowest low bar, that's the entire bar, not the lowest low, I'm talking about the bar itself. You should be able, if the technicals are confirming or the chart pattern confirms, you should get at least to a peak D, and then you got to decide how, all you need to do is, as the song that we sang a couple of times during the 2-day webinar, the wave goes to A and then to B, even the anticipated C and D. That's when it flashes a cautionary light. But all you got to do is make your stops real tight. So what we're looking at here is a match between the takeoff from June of 2012, from 12,035 to 12,089, so that's an 860-ish point rally. We've gone from 12,471 in this particular move, which is matching the rising wedge formation, which, let me repeat, rising wedge formation usually says when you reach the apex, very often in my work it's D, maybe it's E, you should have a pullback. The theory goes that it should could pull back very sharply. My theory is that it pulls back, but it pulls back to the nearest left side strength at either a trough, a moving average, or you got to watch the MACD and stochastic that they don't pull back too much, and the MACD just has a very narrow beta between the fast-moving average and the slow-moving average. So where are we right now? We've gone to 13,195. So in the other one, we had an 800 point rally. 800 points above 12,478 is 13,270. We've gone to 13,195, very close, maybe within $80 of that. So although this is already accelerated to E in just a little extra number of bars. Let me count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15th day of this rally from the low of 12,471 on the 16th of November. And 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 to the rising wedge. And then 12, 13, 14, 15, 16, 17, 18, 19, 20 to that peak D. So, yes, there's a great similarity. No, there's a difference. Now, what is the difference? The difference is that in this particular move, from the left side to the right side price time match, there was a peak, a very nominal small little peak at 12,931 back in May. That was the 10th of May of 2012. But really it was 13,338 was the major left side top that we had to look at. 13,000, that was on the 1st of May. So here the difference is that there is a chunk of resistance right in the 13,250 to 13,290 area. That's the difference. So now let me put it into perspective. The MACD is very strong, just as it was when it went to the peak C and even D back in the summer of 2012. The stochastic has rallied with a very strong move. Basically, it's the second big move to the upside. So we're talking about leg B. If you had to look at the stochastic fast moving, and if you had to look at the on-balance volume, it's actually leg D. In not such a great rally in the on-balance volume. So volume hasn't been picking up. What is the on-balance volume? It's a cumulative value of the price, the last closing price of whatever it is you're looking at, whether it was up even one tick or down by one tick. If it's up by one tick, then it gets added to the cumulative total, and if it's down by 1 tick, the whole price of volume gets subtracted. It's a real simple thing invented. I would like to say it was invented. I'm not 100% sure. That I know that a bulk of the work was done by Joe Granville. Now look at this. There is no sign yet in the technicals that there could be, that there will be a really sharp decline that takes the Dow decisively under the 12,916 200 period exponential moving average to the low of the Roman candle of 12,765 on the 28th of November. Ha! When you look at that peak C back in, what was it, July? June 20th, 19th, 20th, at the highs of 12,898. Where did it come back to? It came right back to 12,452, right on the 200-period moving average. So the risk right now, if we were looking at apples to apples, and so far, there is enough evidence to say we really are looking at apples to apples. I'm not talking about the market. I'm talking about the Dow Jones Industrial Average, trading right now up 29 to 13,184. There is enough evidence to say, yes, we have a similarity here. 13,051, the 9-period moving average, the maroon-colored line there, is the first moving average. If this is an apex, and everything I'm looking at it, all the stocks that we own, we have 4 longs, and I don't want to give this just off the cuff here. Let me just double-check, because we have 4 longs, and 1, 2, 3... I've got 4 longs. Where's the 4th? 1, 2, 3. 3 of them are up, and 1 is just 2 cents off. No, all 4, right this very second, all 4 are up. Well, that's the way you have to look at this market, a bifurcated market. If you're in Apple, you have a little problem. If you are in AZO, AutoZone, you have a little problem. The stocks that are giving very clear signals as to their monthly charts to say there's a timeout coming are the ones that are suffering the most here. Celgene is working beautifully. There are a couple of stocks that are acting really well. So let me give you a summation of what I'm assessing right now. I believe that this buy mode is really close in the ChapmanWave on the daily basis of the Dow. It's really close to having some kind of a pullback. The pullback at this particular point, I would say, could be initially to the 13,051 level, but maybe 12,916 will be the real test of whether it's going to take more than 3 sessions or it's going to go into the 5-session consolidation phase. Right now, I have to call it a consolidation. My 4 Dow stocks, my Dow Quartet, GE, IBM, MMM, and UTEX, the bias is towards the upside at this particular point. So let me run the numbers as we go to a break at 877-927-6648. We'll talk about Tiger Dollars. We'll talk about, I'm doing an average show. The Dow is up 28. The S&P is up 2.5 to 1420. The company is up 15. Gold is up 8. And bonds are up 0.04. I'll be right back.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Happy holidays from TFNN. Our most rewarding Tiger Dollar sale is back this December at TFNN. Normally, we offer only a 10 to 20% bonus on Tiger Dollar purchases, but through December 19th only, when you purchase Tiger Dollars to spend on any of our products, you get a 25% bonus on your purchase, and up to 10% of whatever you spend will be donated to the Salvation Army in your name. You'll receive a personalized thank you letter directly from our local Clearwater Salvation Army administrator in appreciation of your donation. Tiger Dollars can be used on any of our newsletters or subscriptions, never expire, and are fully transferable. Take advantage of our most rewarding Tiger Dollar sale of the year right now. Visit TFNN.com for all the details and to make your purchase today. Happy holidays from TFNN.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Hi, folks. We're back. Dow's up 30, S&P's up 2.47. Interesting the way the Dow is led, and there's been such a lagging component here with Apple dragging down the NASDAQ and certainly the S&P. But, in fact, I've been mentioning this to my subscribers for a little while here. If it wasn't for the so-called talk about the fiscal cliff, this market has been handling everything very, very well right up to this particular point. Have a question of the day, and I'll get to that. And then I'm going to say, folks, this is the week, a really important week. I know that my attendees for my 2-day webinar got a fabulous deal because they were able to use Tiger Dollars for the holiday special, and every purchase led to a donation to the Salvation Army. I mean, what? This is absolutely, it's one of those few times you really see a win-win-win situation. Why? Because you get a $25 bonus match with Tiger Dollar Holiday Special. This is the best deal. I mean, we remember they did it last year, Tiger, TFNN, and was a great success. And Tom was able to send just a beautiful check to one of the best non-profits there is. The Salvation Army. I might be wrong, but I'm pretty sure that I've read before that their administrative costs are possibly the least of any major institution like this that has such a wonderful purpose. So it might be in the 2%. I don't know what it is. It's just a great deal of the money actually goes to those who need to benefit the most. So please go to the front page, purchase Tiger Dollars now, get 25% bonus match, plus TFNN donates up to 10% of your purchase to the Salvation Army in your name. You get the tax deduction. And at a particular time like this, when everyone's talking taxes, you know taxes are going up very soon. This is a great time to do it. So that's number one. Number two is I will be doing Larry's show. Larry, I believe, is a little under the weather, so I said, fine, I'm right here. I'll do the show at 1 o'clock for Larry. And that, of course, is Larry's Trade What You See. 1 hour, that's at Monday. Larry's on. I'm Monday through Friday, 11 o'clock till noon. And Larry's on Monday, Tuesday at noon, and then on Thursday he has the same show, except the name of it is the Commodities Hour. So I don't mind. I'll pick up commodities if you want during that hour. So that were the two things that I want to discuss. The third is there's a question in the den. Basil, what do you say you expect a big up move out of this wedge? No, what I was saying is that the way the rising wedge works, and look, here it is in the Dow Diamonds. If you look right, I'm going to make it in some dark color. What will I make? Let's make it maroon. Maroon there, and maroon there. So the rising wedge formation says that when you get to the top of the resistance of two rising trend lines, but the bottom one is rising at a much greater degree. So now you've got that wedge or that ice cream cone from the ice cream falling out at the bottom to the tip of the cone at the top. That's a rising wedge. What the rule is that, and actually my rule is that the rising wedge needs to hit the rising trend line only a couple of times, because the longer it hits that trend line, the greater the chance is that it's going to not necessarily slice right through any resistance, but there's a greater chance that it's going to ruin the pattern by going higher, quite a bit higher than that trend line, and then you have a different pattern altogether. It could have the same result. So all I was saying is that the question always has to be, what do you look for? What should you expect? Where are you surprised? Or where does it go wrong? And going wrong here is that instead of the Dow plunging, which it should have done Friday, if not today, Days Young could still do that, but it is out two bars in the diamonds and 1 bar, I think, in the Dow. Yeah, 1 bar in the Dow has gone above. That's today's bar. So it's still within the realm of possibility. Most importantly, what I'm looking at is that if it breaks to the upside, my guess is that the left side, right side price time match, which comes in between today and tomorrow of 13,290 is a possibility. That's what I'm saying. And then all of a sudden you don't have that pattern anymore unless you can find another point to join the uptrend resistances. So needed to clarify that. And what's even more important about this particular pattern, you see, if I take this, oops, there's so many trend lines here. If I take that away, and sometimes I want to take it away because it can mess up things. I took away that circle. You see that there's the arch formation that I've pushed it up a little bit. That arch formation is still a possibility that we can make a turn. I'll talk about the weekly and monthly because I spent a lot of time for my subscribers showing over last week and this week the long-term charts. I'll be right back. Basil Chapman.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi, folks. Basil Chapman, Tiger Technicians Hour. And let's see. The Dow is up 30 at 30,185. S&P's up 228. Let's see. The Qs, the NASDAQ comp is up 15 at 29.93. I was asked in the den if I would look at the E-minis, the December NQZ contract. Now, it's very interesting. I suddenly started doing the March contract. Usually I wait. For some reason, I got confused because of all the things that were going on. And I thought that 26, 23, 26, 23, 22. And I thought that on Thursday, Friday, I must quickly switch over to the other contract. Then on Friday, during the webinar, I'm busy working away. And I couldn't get one of the futures contracts. And then I went to the ESZ12. That's the December E-minis, which I thought were going off the board. And lo and behold, they were the ones that were tracking beautifully. And the March contract had very big gaps, and it was not a very clear contract. Thank goodness. So it allowed us to do it. So I'm looking here at the December contract of the NASDAQ 100 December 2012 E-minis. And they're trading at 26.55 right now. Now, the question was, Let's see. The question was about the rectangle formation. Is it covered in the CD? It's covered in a different way. Now, maybe I'll talk about that. I'll have a quick review of it in the break. I'll explain how it's covered, not in the same regard as and depth that I have over the more recent years, because there are other things that have gone on that I needed to allow time to pass to be able to test it and check it out. And basically, my conclusion has been that rectangle formations can last a lot longer than your patience. Now, that just sounds like a trite, very kind of off-the-cuff remark. No, it's not, but absolutely not. It is a remark that is, how can I put it subtly? It's cost me a fortune. And the reason is, there are times in trading the E-minis that I like to do during the day, or in the evening, and I sometimes do it consistently for weeks and weeks, and then other times there's so much going on that I find my mind is not set right. Now, my technique is set, but my mind is not set. And if the mind is not set, I advise you, I didn't mention this in the webinar, I meant to, if your mind is not there for trading, don't trade. You've got to be focused. Once you've got the trade, you can let your mind wander a little bit as long as you know your parameters, but don't do it. So what used to happen is, as there was a price that looked like it was going to break out, it went peak A, then peak B, and it was just bumping against the resistance point, I would say, great, it's going to break out, and I'd go long. And I would invariably do this towards the middle to the latter part of the day after I'd done a couple of trades earlier on, done very nicely. And then I found, good grief, I'm giving up some, or in some cases all, of those gains by trading this pattern, thinking it was going to break out to the upside or to the downside. And then what I found was that these rectangle patterns stay there for a long time. Now, a long time, if you're looking at a 120-minute chart, I would say a long time is over a day and a half to 2 days. I've seen these patterns in the E-minis trade for 10 days. There was one that I showed the Den 4 years ago. I remember 3-4 years ago. I was overseas at the time, and I hopped into the Den. We were looking, and I said, be careful. Remember what I mentioned on Thursday about the rectangle formation? This was already Friday the following week. I said, look, we've gone from Thursday to Friday, the 120-minute chart, and we've not yet broken out. And what will happen is, if you learn how to trade this, which is now something I tend to do a lot better, is that I trade it so that as it's bumping into the resistance, and in this case, what the NQs need to do is to break decisively above 2679.25. Let's call it 2680. Once it breaks above 2680 and is holding, it can go to the upper rectangle formation that was forming. At this point, I've got it in leg B, almost failing, coming back to the low of 2622.50 made at 10 o'clock on the 6th of December. And look at this. So actually, look at this. We're talking about a trading range that began on the 5th of December at midnight, and it's continued between that range and the 2622s, and it's already the 10th of December. I mean, how about that? It's a little bit of a wideish range, but hey, it's a range. Look at the last one. The last one went from the 29th of November all the way to the breakout, or breakdown, I should say. Actually, this has to even extend. There. Finally, that broke down on the 5th of December. So this is what I'm saying. The question is about the rectangle formation in the Chapman wave. The rectangle formation is where I identify a certain price point as a potential low. It might have been a break up in this particular case from on the 28th of November at 2665.50. There was a break to the upside, and they contained the price between the peak D high of 2689-ish to the final one at 26.98.50, and then it pulled back. It dipped underneath a little bit, went right back into the rectangle, so that even though there's that moment that it does take out the left side low, that was only trough B, and it went right back in. Now it's gone to trough C and D and has formed this next rectangle. So the parameters to watch, looking at on the rectangle, this is not a trading, I'm only saying this is what you've got to watch, is that on the downside, the support between 26.25 and 22.50 is going to be key. On the upside, the resistance between 26.62 and 26.73 is going to be key, and it might stay in this range for a little while longer. So you might only get peak A, B minus. Now there's another leg A. It might pull back and make another leg B, B minus, come back again. So that's what you got to watch out for. So I hope that answers the question. That rectangle formations, identify the top and the bottom. Don't be too eager to trade a break out to the upside, because these things can be real powerful repellents, and don't be quick to trade a break down to the downside, because the support could be quite strong. And all you need to do is identify that you might want to be shorting instead of going long in the 26.70 2.5 to 26.73.5 area, and you might want to be buying down to 26.25 to 26.22. Until that changes, that's the way I would be looking at it. So wooden from 1128. There's a much larger one. I would prefer, the question is from 1128. I would go to the bottom of 1128 on the 200 period exponential moving average. Well, you could do that, but I've already covered that, because I've said that the 26.22.50 would be the level to watch. The low was 26.11.50. That's another 11 points down. So I would stick with the smaller time frame first. There is an arch formation that, here's the other thing. If you're able, this is what we spend so much time on during the Thursday and Friday sessions, the arch formation. Try your very best to identify where you can see an arch formation, and then see within that context, is there a possible H that's going to an M formation? If you can identify that, that's already, you're way ahead of the game, because you're saying, this goes under the ChapmanWave methodology. That's in the book, CD Introducing the ChapmanWave Methodology, as a large arch formation that has held support above the previous low, which says, great, now you can trade and have another little mini arch, but you probably are not going to yet take out the left side high, and that's 26.79.25. Where was the last high? 26.73.25. 26, 6 points lower. And this one, theoretically, could retest the high and just nominally take it out, but I've already drawn in the arch formation, which says if the arch goes, lowercase h, but this case is an arch, goes to a little mini arch, and then that turns into an M, lowercase m formation, in other words, a second arch, be careful, because it's liable to test the bottom and break it, and that break will say, whoops, I'm going right back to test the body and go back into the 26.22 area. So I hope that helps. It might sound a little complicated. I've been showing the chart pattern with my pointer, so if anyone was looking at Tiger TV, it really helps. I said it the other day that I've said it many times, but especially in the webinar, I admire people for being able to do this. It's very difficult for me to keep concentrating. Even this morning, I took an old a set of notes that I had on Hurst. J.M. Hurst's thesis on cyclical analysis, and I've already read it, and I know I believe Larry was friendly with him, knew him very well. But I'm reading in the 8 principles of Hurst's cyclical theory. I read the first one, commonality, grades going very nicely. I read the second one, cyclicality, and I'm not even finished the sentence, and I find myself already thinking of it in terms of the Chapman wave and the cycles, and I'm already off track. So those folks who did it and actually were able to sit through all 2 days worth and are going to be able to review it, bravo to you. But I know I have to have the charts, and that's why I felt, in many ways, I felt that it was a successful webinar, because I did monitor myself by moving from the talking written page to the live charts that we went to, which made a big difference for me. And that for me was it really made a difference. Now I have a caller on the line, Chris in San Antonio. I'd love to go to Chris. Hi, Chris. How are you?
Doing good, Basil. How about yourself? Very
nicely, thank you.
Hey, Basil. I'm short Whole Foods Market, and you've been talking. I've been listening to you, and you're saying that you think the market's going higher. So should I just close this trade? Or
I'm so pleased you called about this because it's the pattern that I was just discussing, the arch, the very large arch, which goes to another mini arch, which can go to another arch, which another mini, which is the big arch becomes, I call it like the letter H, and then the little, it turns into an M pattern. That's the one I just showed a moment ago on the 120-minute chart of the NQ E-minis. This is the same thing that we're looking at now. Look how, folks, we're looking at Whole Foods Market. Now, I have to tell you something about Whole Foods. When they came on the market, I thought they were fabulous. And then there was a period where I thought, even the local Star Market, Shaw's, is getting organic this and organic that and organic this. That's going to create tremendous pressure. I'm fortunate, I was telling someone last night, I'm within 1 mile of two Whole Foods, whole paychecks as they call them, 2 Whole Foods markets, 1 Shaw's and Trader Joe's, plus other little places around here. So I really can get a feel for the way each market is handling the inflation in the consumer goods, like certain, I'm looking at cans of stuff that I'm looking at prices that have, and boxes of whatever it is, even the rice, what do you call it, the rice that I happen to like, and once in a while I'll have it. It's that white packet with, they have couscous as well. Rice pilaf. And I'm looking at it, I'm saying, wait, what happened to the $1.85 I used to pay? It's up in the $2.80s, $3 area. So there's been huge inflation. Well, I think that Whole Foods has handled it really, really well. They've kept their integrity. And what I was talking to someone recently about it, and he said, yeah, they have a fantastic business plan. Because I said, I'm looking at them trying out different counters and different things, and they're always modifying it. I notice what's good, and then I notice that they turn it into a name brand. I don't know whether they buy the company or they ask the company to make it specifically for them. Trader Joe's does that. So I think that their business plan is on track. My chart says that their business plan might be on track, but they are going through a big digestive process right now. Now, I could be wrong. Look at the high, the all-time high was just 2 months ago, 99.86. It's trading 5 points lower than that. That's really good action. My weekly, that's a peak F right there. I've got no other wave count. At this time, it could recycle up into an instant restart. I don't think it's going to. And the weekly chart is with all that's going on, with Thanksgiving, which should have been a big boost to them, and now the next holiday season coming up. I'm looking at this chart, and I've got a price target on it that says there's a real good chance that if by the end of this week, the low of last week, which was 89.02, is tested and taken out, and I don't care what the reason is, but if 87.42 is touched at any point this week, which shouldn't be, 87 is 4 points, so something's going to have to happen. There's just a really good chance this is going to work its way down and test the low of 79.55 made in July, and I'll explain what I'm looking at as soon as we get back. I'm going to say to you, at least stay in this position. Let's talk a little bit more when I get back, and I'll give you some parameters that I'm looking at for Whole Foods, because it's holding really well, but it's not rallying with the market. So hold on, I'll be right back, Chris, and with Brian.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. We're back. Basil Chapman. Let's see. All morning I've been saying it's up 28, 29, 30, 33. Dow's just slightly higher. I guess McDonald's is helping, and S&P's up 217. What's interesting is that for the first time in a while, the Dow is up 22.22%, and the S&P's up 15%. That's kind of the closest they've been for quite some time, because the S&P's been lagging the Dow. Now we're on with Chris in San Antonio, who has taken a short. I just need to ask you, Chris, are you profitable in your Whole Foods short at this time?
Yeah, I'm short at 93.22.
Okay. That helps me a great deal. I'm going to make a suggestion about that. Number one is you keep a core position there. And I would even say to you, I prefer, once you have a decent gain, to make absolutely sure that you do not give away anything. You can break even, but don't take a loss on the position. That's number one. But here's the other thing that I'm looking at. If Whole Foods is able to bounce just a little bit, maybe to 91.97 to 92.40, somewhere in that range, if it just starts to turn down after that, I would add a small trading position, and that trading position should have a stop somewhere around 92.63. So it's really tight. You've got maybe a 60 cent. And I'll tell you why. I think your core position, the 92.50s, is, to me, that's kind of the limit that I'd be looking at. It could possibly go to 93, and there was a high of 93.19. But your position right now, it looks to me, from the way the market is acting, the way Whole Foods is acting, that there's a very good chance, based on the weekly chart and the turn down in the monthly chart, which is only starting to work, but mostly that weekly chart, because for 3 weeks now, the 9-period moving average has been tremendous resistance. I think you've got a very good position. I would like if you could get a trading position. Why? Because this pattern says if it goes to 87.80 to 87.50, there could be another arch bounce. So right there, you would make it stop on the trading position real tight, and you can add to it again if it bounces to 90.85, the 9-period exponential moving average. And you could keep doing this until it finally, and I believe it will, until it finally breaks the low of 85.70, which was made in the 14th. Then your trading position, you can have a trading stop, and you don't even have to worry, because your core position is going to look very good based on my weekly chart, and then the monthly chart kicks in. So I love your position. We are both going to be wrong if it spikes suddenly to the 94.70 to 95.60 area. Then I have to say, this will start to look like the GLD chart in the monthly that just kept going sideways, making the arch formations. Even though the upside was limited, the downside was limited. So I hope that helps you in just conceiving how the big arch goes into a small M-shaped pattern, and that's what's happening now. And that rectangle formation in the weekly chart that's been going on since it broke down back on the 8th of November, that arch formation's been going on for over a month now, and tells me that the 200-period moving average of 92 in the 120-minute chart is really strong resistance. So I hope that gives you a sense of what I'm looking at. And it's still on my list to possibly short. We did have the short, and now we're out of a short. I'm thinking that I'd like to, because of that monthly chart having a possible hat-trick top, I want to be back interested in this again. So I hope that helps you.
Okay, thanks a lot, Basil.
Thank you very much, and thanks for calling, Chris. Brian Jackson, how are you? Jackson, Mississippi.
Hey, Basil, thanks for taking my call. And I know you don't have much time, but
I got time. Oh, I haven't got much time, but I've got Larry's show coming up. But you want to go to the UNG?
Yeah, UNG. I took a options position on Friday in it, and it's broken down below the trend line. And real quick, your opinion on that?
Okay, so you're a long. It's an option call.
Right, January.
Wow, I did. Once it didn't rally, I didn't like it at all, and I'll tell you where I think it's going. Whoops! Before we go to the break, and then I'll be doing Larry's show. I don't know if you can hold on for Larry's show, but that candle of 18.91, the low of the 20th, that's its target. If